Good evening, everybody. Luke Gromen, founder and president of FFTT, Forest for the Trees. Thank you for joining me tonight. Quick hello to everybody that's going to be watching this on the replay. Got to watch my beloved Cleveland Browns end a 17-game losing streak with a tie, which for our international viewers in American football is exceedingly unusual. So at any rate, we're going to jump right in. Like I said, new format, two things in under 2 minutes. The first thing that has gotten my attention recently has been that 10-year U.S. Treasury yields are not dropping despite what, for example, Bloomberg called the longest emerging market rout since the financial crisis. You've seen emerging market currency volatility the highest, reaching the highest levels of over 10 years. And yet you're not really seeing a firm bid in 10-year Treasury yields. And to us, it's a very big non sequitur, especially in light of the ongoing increase in the S&P 500 over the TLT or long-dated Treasury, SPX over TLT ratio, as well as recent comments that we retweeted on Twitter a couple weeks ago from Matt Casey, noting that investors that he had met with in Dubai would look for crisis alpha in the next crisis, wherever the genesis of that was, in U.S. equities, not in Treasuries. And so is Mr. Market beginning to discount this by the fact that Treasury yields aren't being bid despite the increasing volatility in emerging market currencies and emerging market assets? And in our view, it's possible that this non-decline in Treasury yields is a rising pressure gauge in its own right. Second thing that's grabbed our attention recently has been the amount of noise and conflicting noise in the media, just in the last week alone, for example, about the geopolitics of the dollar. So you had Bloomberg talking about the weaponization of the dollar openly. Malaysian Prime Minister Mahathir asking why should the dollar be the reserve currency or the standard versus the yuan, but then turning around and Malaysia canceling a Chinese pipeline project. News that India was looking at Russian S-400 missiles, and then turning around getting a waiver from the United States regarding imports of Iranian oil. ExxonMobil looking at a big pipeline project in China. France and Germany wanting to get away from being from the dollar's dominance in the foreign policy journal, which is curious. And then Trump upping tariffs on China, or threatening to at least, of course, on Friday, but including on U.S. economy, quote unquote, golden child, Apple. And so, continue to think that markets are underestimating the degree to which U.S. and China trade tensions are underpinned by issues that are matters of existential national security to both. Our view on the rising quantity, the rising volume level, even some of the conflicting direction on topics, and topics that were either ignored altogether for a very long time or considered conspiracy theory, but now being openly discussed in Western mainstream serious media, is a real signpost on timing in our view. And so we think we're getting into the middle or late innings in terms of some of these tensions. So those are the two things that have grabbed us recently. If you want to check in on our website, it's always a good place to see where we're going to be, etc. FFTT-LLC.com. In the meantime here, let me check and see if there's any questions people have. Let's see. Can you explain the neutral rate comment you tweeted? Yes. The tweet in question, somebody noted that the calculation, there was an article on Reuters that somebody noted that the calculation of neutral rate, or R star, that the Fed is attempting to manage to, may be tricky to manage to because it's influenced by Fed's actions. And so there's a degree of reflexivity that may be involved with that the Fed is not necessarily factoring in. What we said about that is that policymakers around the world have been going around and systematically basically breaking the smoke alarms that would be telling us that the policymakers are doing something wrong. It started with gold. Then it went to the JGB market, Treasury market. What the European Central Bank has been doing in Europe is much the same. And so when you look around, you're looking at a crowded theater where all the smoke alarms have been disconnected, save for a few. And what I said is there's a few of them that are signaling something, but that virtually no policymakers pay attention to it. And virtually no investors. One of those big ones is, of course, physical gold flows, which have been very obviously leaving the West, going east. Central banks buying more gold and treasuries, but again, asking a central bank or a policymaker in the West about physical gold flows is just it's not considered polite, basically. So that was what I was tweeting about there. Any comments on first week of delivery in yuan? Also, why volume and open interest is in next December. The question regarding yuan oil contract volumes, delivery volumes, I think they 600,000 barrels over the course of 5 days was the last story I saw. It's not a lot. That said, it's delivered and it's settled, and it's despite all commentary that it would never happen, that delivery is onerous. Obviously, it did happen. Delivery is onerous. Vis-a-vis some of the, is what I've heard from a number of the a couple different oil traders I've talked to. But what's also very interesting is talked to more than one oil trader that 9 to 12 months ago thought that this contract had no chance of succeeding, and they've changed their tune almost 180 degrees since that time. Minimal level of delivery or open interest for September at that point at this point, in the yuan oil contract, from what I've seen, 1.3 barrels. Last I saw, though, the December open interest was a lot more substantial, 37 million barrels of open interest. We'll see what that contract looks like as we get into delivery time frame. Also just saw before I was logging on here that China's maybe talking about opening up QFIIs, which are, I forget what it stands for, but it's effectively quotas for foreign investors to invest in commodities in Shanghai. So that might be something worth watching on this front as well. Target level of gold for September. I don't know. I wish I could tell you a number. I continue to think, ad nauseum, that what we're watching in gold is telling a very important story being ignored by most people, which is to say it's effectively a gold being pegged, a dollar pseudo gold peg, or the London Gold Pool tool. COMEX inventories are basically back to all-time lows. GLD continues to get drained to physical tonnage. None of this is going to matter until it matters. So it's just not really any number I would pick for a near-term price action would be unfortunately random and in the end meaningless. COMEX about to hit an inflection point. Heard much about why COMEX holders not moving to eligible. My understanding of the difference between eligible and registered is that you can move inventory from eligible to registered, but the best way to think about it in simplistic terms is that the registered is basically available for delivery. Eligible belongs to somebody. And at this point, with gold having done what it's done year to date, my guess is you can move that eligible to register, but it would require a pretty big move in gold prices. For example, if you look back in early 2016, the last time that we had COMEX inventories this low was in early 2016. You were able to move inventory from eligible to registered. With that said, gold prices on COMEX rose 30% or so in the first quarter of 16. So that's not to say they can't move the inventory, but again, in theory, eligible sort of quote-unquote belongs to somebody. And if somebody still holds it, my guess is they're going to want to get paid to move it. So that's how I would think about that. Could the WTO suspend China for breaking rules with a 90-day period for negotiation? I'm just not familiar with WTO rules and what that would entail, so I don't want to mislead you to say that they could or could not. I would have to look into that. So unfortunately, I don't want to mislead you on that front. Did U.S. turn India about receiving Iran oil imports? It's a very interesting question. I sort of lumped that in with the second of the things that have grabbed my attention recently. I think there's two angles to it. I think there is I think there's two ways to think about that, both a tactical and then also the longer-term strategic dynamic of it. And so tactically, I think the way you phrase that question is very astute. In other words, India came out and said we were thinking about buying Russian S-400s, and the U.S. Came out and said, hey, we'll do a weapons deal with you, and we'll grant you a waiver with Iranian oil, so that you don't have to cut your imports as much as we might have said before. And so to me, it looked like there was a bit of horse trading going on in the background. You never know what all the quid pro quos are, but it does seem to be some level of diplomacy happening surrounding this, and that's the tactical side. From a more strategic perspective, something that I think most people are continuing to not appreciate, particularly here in the West, is once the Berlin Wall fell in '89 and the Soviet Union broke up, the U.S. has been operating in a unipolar world where it can pretty much do whatever it wants whenever it wants. Most senior policymakers, most people in senior seats in policymaker and economist seats have been operating this, have come of age of this. They are simply not looking at the way that a second big player creates bargaining power, then that shifts that bargaining power from the U.S. to an India, to an oil exporter in these types of scenarios. And that has important structural implications over time. So that's more a strategic type of view of what may have been transpiring between India and the U.S. and Russia. But I think there's two ways to think about that, tactically and strategically. Let's see here. Let's see. Gold is backed by physical gold. They hold physical. It's not a. It holds physical gold. You can't get it, and there's force majeure language in the prospectus. In theory, you can get it if you own 100,000 shares. It is to say it's backed by physical gold is, I guess, technical at best. Most undervalued market today in the world, not even a question, it's gold. It's not even close. And the way I say, people say, well, you can't value gold. That's not true. The gold's PE is looking at the foreign held debt of the world's reserve currency. And so if you look at the dollar, you look at U.S. market value of U.S. official gold, and then you value that versus U.S. foreign held treasury bonds out there. And you can see prior to 1989, that ratio was almost never below 20%. In 1980, at the last gold peak, that ratio was 133%. That ratio today is around 4%. And so to be valued as a multiple of, or as a percentage of U.S. foreign held treasury debt, the same level it was in 1989, gold would have to be about $5,000 an ounce, or $6,000 an ounce, 5x, 20%, 4% today, 20% then, so 5 times 1,200, 6,000, to be valued equivalent to the 1980 valuation at 133%, you're looking at, I don't know, $35,000 or $40,000 an ounce. So it's been interesting to watch global central banks, particularly those that are being accused of being revisionist, China, Russia, Iran, others, Turkey, buying gold, given that. Thoughts on yen going higher on news of Japan possibly next tariff target? Seems counterintuitive. It does seem counterintuitive, but it's counterintuitive in this much the same way that the dollar being cut out on the margin of global commodity markets is in the near term positive for the dollar. It's a way to think about it as a short squeeze. So if there's a single currency that that is used more, or at least was historically used more in funding than the dollar, it was the yen. And so to the extent that you're talking about a risk-off scenario for Japan, or for interaction between the U.S. and Japan, it should drive the yen higher, I would think, ultimately, which, again, counterintuitive, but that's what it is.
New York Times article on the resistance. I'm assuming any comments. I'm assuming that is on the op-ed. Look, I think a lot of what we're seeing on populism is simply real living standards declining in the U.S. being marked to market. And so I think there are a number of different dynamics going on within Washington between those that support Trump, those that don't support Trump. Clearly this person and a number of others don't. To me, the bigger picture, I almost take more information from it, from the bigger picture perspective, which is, I'm in my mid-40s. This is not anything I've seen in my lifetime in terms of the political disruption going on in this country, the tension, the divisiveness, and that to me is noteworthy. It speaks to a level of concern, desperation, frustration that belies the narrative, the overwhelming narrative here that we're going to win the trade wars, China doesn't have a chance. If we were so confident, I'm not sure why we're throwing arrows at each other. And so it's not to say for sure China's going to win, but I just think that it's a slam dunk. I don't think it's as a slam dunk as the narratives would seem to say at this point. Do you think the 200 billion and 270 billion tariffs will ever be implemented, or is it all a bluff? I think it's a bluff at this point. I think that if you read some of Trump's books in the past, if you talk to some of the people that have dealt with him, he sort of operates in negotiations in a method of, quote, if you want a dog for Christmas, ask for a pony. So. I think the 200 and 270 billion might be an element of asking for a pony with the hopes of getting a dog. China is pushing back pretty hard. You've had some soft-spoken diplomats, people who are reportedly soft-spoken diplomats, saying that we won't be bullied, we won't be a vassal, we're not going to do another Plaza 2 or another Plaza Accord. So ultimately, to me, it seems like there's a lot of negotiation going around. And I think the end game has to be the dollar's weaker, and it might be weakened via, politically. That is not a high probability. People aren't assigning a lot of probability to that at this point. But I ultimately think right now it's more of a bluff or a bargaining tool. Maybe not a bluff, but a bargaining tool than something that they're hoping to implement per se. What do I think about emerging market countries' stock markets? To me, I think emerging market, obviously high correlation with what's been going on with the dollar. One of the things I've been watching closely has been the weakening U.S. economy. Ultimately, I think, we've talked about will the Fed shoot the hostage, which is to say, hurt the U.S. economy badly in order to defend the dollar, and increasingly, we don't think that that's the case. We think the Fed will blink. You've seen some softening in some of the services numbers, housing numbers, auto numbers already. Let's not forget, there's big parts of the U.S., around the energy sector in particular that look like an emerging market here in the U.S. So our bet is that the Fed will blink sooner than most people think. If they do, that would be very positive for emerging markets, stock markets broadly speaking. China earns $600 billion plus each year, spends it on buying foreign stuff. Where do the U.S. dollars go from there? That is a great question. When you look at who ends up with it, you're basically China's getting control of commodities. Ultimately, to the extent that debt is held by some of these commodity producers in dollars, as has been very well advertised. That helps them service their debt, their dollar debt. Maybe they retire certain dollar debt. Maybe it ends up back here at the U.S. But I think when you look at the structure, we send China dollars. China ends up with a dollar surplus. China takes the dollar surplus to fill in the blank oil exporter who may have dollar denominated debt or other liabilities. China says to the oil exporter, we'll give you the dollars. And you commit to giving us X amount of oil over X amount of years. China locks up future supplies of oil using those dollars. The exporter has dollars, then they can do what it wants to do with relative to its dollar-denominated liabilities. And so I think there is they get offset that way, I think. Richard Duncan said U.S. debt situation isn't as bad as talked about. Any thoughts? Do I agree? I disagree. I had a conversation with someone recently where they said, look, U.S. debt to GDP is only 100%. And that's sort of true on a frontline basis. But what I went back with is yes and no. U.S. debt to GDP, if you include entitlements and off-balance sheet liabilities, it's somewhere between 500 and 1,000% of GDP. And this person said, well, those are off balance sheet, they don't count. I said, well, they don't count till they come on balance sheet. And guess what? They're coming on balance sheet at an exponentially growing rate due to U.S. demographics. And other people have these same problems, but to me, it always comes back to one thing. None of these other places are the reserve currency. If we print all this money, we will destroy other economies as their oil bills, their commodity import bills rise significantly. We'll export that inflation. We had people say there was no inflation during QE. Well, there was a little bit here, not a lot, but there was a lot, and it hurt. It helped cause the Arab Spring. It helped cause problems elsewhere, and that was just with a modest $3 trillion in balance sheet expansion. We're talking about large multiples of that number. Do you think U.S. is looking for an excuse to do QE? For the bad fiscal situation. I think the U.S.'s operating room is getting smaller and smaller. A perfect example of that is an article from last November in the Wall Street Journal in which it was noted that the U.S. Treasury did what they called a surprising 180-degree turn. At that point, or before that point, Secretary Mnuchin had been talking about issuing ultra-long Treasury bonds. Hey, let's term more of this debt out while we can, while rates are low, markets are favorable. And then all of a sudden, Mnuchin said, yeah, we're not going to do that. In fact, we're going to, for the first time in 10 years, we're going to stop trying to extend weighted average maturity. And it was said that, well, the Treasury is choosing this. Our view is that the Treasury was choosing to do that in the same way that I chose this weekend not to buy a Gulfstream 5 for FFTT to fly for my business travel. It's a choice. I couldn't afford it, but it was a choice. And when you read the article, they were concerned about hurting the housing market. The supply of 10-year treasuries would hurt the policy rate at the long end of the curve. And so when you think about the U.S.'s fiscal situation, it's a situation where the U.S. is having to issue more and more debt at shorter and shorter maturities, financed more and more by the U.S. private sector. And inevitable isn't imminent per se, but underlying all of that as well is you've got to find some sort of source of funding, but a big source of your funding comes from the stock market through tax receipts, as Alan Greenspan notes. So it's a bit of a circular argument. One thing I do say when you say a market crash, if the market crashes, the Fed's going to have to be doing extraordinary amounts of QE very, very quickly. And when I say extraordinary, I would start, when we've looked at the math, the starting point is probably 200 to 250 billion a month, and it could be more than that. Dollar versus the milkshake theory. The milkshake theory, yes. Brent and I have had some epic discussions about this. Ultimately, I see aspects of exactly what he's talking about. I think, to me, it's less that, where my disagreement is with it is from a sustainable standpoint, it's going to be very difficult for the U.S. to get rising equities, rising rates, and a rising dollar for very long at all. Just given how interconnected things are, how big emerging markets are, how much big parts of the U.S. look like emerging markets. You're basically betting that you can break emerging markets before you break the U.S. domestic economy. The challenge is that the U.S. domestic economy looks more like an emerging market than some emerging markets, whether you talk about the situation of the U.S. consumer, you talk about the U.S. shale sector, you talk about the U.S. government's own finances. Is it possible emerging markets break before others, before the U.S. does? Yes, but ultimately, the faster they break, the more markets are also going to discount how much sooner the U.S. breaks. I mean, I was joking around with Brent about this a couple weeks ago and talked about, he said, hey, when a bear enters your campsite, you don't have to be faster than the bear, you just have to be slower than faster than the slowest camper. And he's exactly right. My point was is that vis-a-vis the milkshake theory, the assumption is that that the U.S. can outrun the slowest camper, and that the bear will feast on the slowest camper instead. My point is that the slowest camper in the United States are tied at the ankle like a 3-person race, and so the second it's going to be a very short period of time between the time the slowest camper falls and then the bear just moves right onto the U.S. All right, guys, that looks like all the questions. Oh, I don't know if the bear's Russia or not, but I guess metaphorically it could be. But at any rate, looks like that's it for tonight in terms of questions. Thank you guys all very much for hopping on. Really enjoy interacting with everybody out there. Look forward to it every Sunday night. And hopefully my Cleveland Browns will get an outright win next week. But a tie is better than 17 losses in a row. So have a great rest of your weekend. And you guys, we'll talk to you all soon. Take care, everybody.